We all know the housing market is a little bit crazy right now. Some people have started to get used to the idea of 20% increases in price, but the reality is that is still a crazy number. Go back even just a couple of years, and if someone told you that the housing market would increase by that sort of amount and even more in certain areas in just 1 year, and then after a worldwide pandemic no less, you would probably try to have them sectioned or sent to a mental asylum. It's no surprise then that many people are starting to wonder when this crazy market will end, and it appears that Zillow is no different in that sense. Yeah, you heard me right. Zillow, the billion-dollar real estate platform that dominates its market in the USA, is starting to look like it's predicting a housing market crash. Their iBuyer program is being halted, seemingly out of nowhere, as the company struggles with the mounting losses that are coming from what we all thought was one of the strongest markets in the country. Today, we're going to look into what has actually happened and why it might have happened and what it might mean for the future. But really quickly, if you're new to the channel, make sure to subscribe. If you enjoy this content, make sure to like the video and leave a comment for the algorithm. Also check out our Patreon where you can join our exclusive investors community, gain access to loads of private content and support the channel. So all of this news stems from Zillow's iBuyer program and the fact that it isn't going as well as expected. Now, for those of you who don't know what that program is, don't worry, I'm going to explain it all to you right now. Now, an iBuyer is a company that buys homes instantly by relying on technology to determine how much the home is worth. These transactions are completed online, usually without anyone actually seeing the property, which means homeowners can sell their homes really quickly while skipping a lot of traditionally time-consuming and stressful steps like listing or showing their home. The I in iBuyer literally refers to instant because these transactions can happen really quickly. Some companies can get you an all-cash offer on your home in less than 24 hours, and the deal can usually close within a couple of days without ever having to meet with an agent or lawyers or even go outside. iBuyers use loads of data and a bunch of algorithms that look at easily available data to try and work out how much the home is worth. Things like the location, the size, condition, and the market surrounding that home all get looked at to determine an appropriate offer. Now, there are plenty of iBuyers out there, but one of the biggest ones is Zillow Offers, a branch off Zillow that was made specifically for this purpose. Now, the idea behind this business model is that the iBuyer wants to buy slightly distressed properties that don't need much work on them. They buy up thousands of these properties across the country, put a little bit of work into each one, and then try and sell them all on as quickly as possible for a slight profit. The important thing to note here is that it's about volume, not margin. They aren't buying homes that have just burnt down. They aren't buying homes at their usual market value. They're just looking for quick deals from people who want to get rid of their home quickly and can't be bothered with all the hassle. Now, thanks to this program, Zillow has done pretty well over the last year according to their investors and shareholders, and the news that just came out stunned pretty much everyone. So what is this news and what's actually going on? Well, a couple weeks ago, Zillow came out and announced that they would be halting their iBuyer program from full speed to full stop, at least for the end of this year. They would not buy a single more home in 2021, and they claimed that this was in order to work through a backlog of homes that they had already bought in the past. Zillow CEO said, "We're operating within a labor and supply constrained economy inside a competitive real estate market, especially in the construction, renovation, and closing spaces. Pausing new contracts will enable us to focus on sellers already under contract with us and our current home inventory." So it would seem, on the surface at least, that this is a bit of a non-story, right? Zillow bought over 3,800 homes over the last year, and they're struggling to get them all renovated at the moment. We know for a fact that there is a labor shortage across the whole of the US, especially when it comes to construction type jobs. And we also know that there are huge bottlenecks in supply chains, not only in the US, but across the entire world as well. Because of these facts, I've seen a lot of people take this statement at face value. They heard what Zillow had to say and they believe them, but not everyone believes what they just said. Mike Delpre, an independent real estate technology strategist, had this to say about Zillow's announcement. iBuyers have access to a tremendous amount of data. They can see months into the future and plan their inventory, so the fact that Zillow didn't see this coming and wasn't able to make adjustments before it had to resort to an iBuying lockdown is pretty surprising. If you're trying to be number one in the market, slamming on the brakes is one of the worst things you can do. You want to make some adjustments before you get to this point. Slow down, switch gears. This is not the preferred outcome for Zillow. So why have Zillow done this? We know that Zillow has access to more data than anyone else, and these supply bottlenecks and labor shortages are nothing new. So why didn't they see this coming? Surely, if they had been unable to process these properties quickly enough, they would have known that this is the case for months now, and yet they continue to buy more homes than ever. Mike also makes the important point that this news, this development, is not good for Zillow. They are a growth company that needs to continue to grow and dominate the market if they are ever going to justify their market cap, and the fact that their share price dropped 11% the second this news was announced speaks volumes about the fact that this sudden halt will be bad for business. Not only is Zillow one of the biggest players in the iBuying space, but it's a huge part of their overall business. For reference, most of Zillow's revenue comes from this iBuyer program. Last quarter, they made $777 million in revenue from Zillow offers and only $476 million from the internet media and technology part of the business. So why on earth would they be so short-sighted as to ignore all these growing problems to continue to buy homes and make the problems even worse, which would then force them into having to shut down entirely? Well, maybe, just maybe, they aren't telling the truth. We all know they have ridiculous amounts of data, not just from their iBuyer program, but from the media and technology side of the business as well. Maybe they are detecting a slower market, one that may even start to go downwards instead of up, and they don't want to be holding loads of inventory when that happens. Now, obviously, I'm not the only person or even the first person to say this. There are a lot of people out there just as skeptical as me. This Bloomberg article documents this viewpoint pretty clearly. Zillow's house flipping hits a snag as the red-hot US housing market shows signs it's cooling. Zillow may be claiming that supply and labor shortages are making it too difficult to work in the environment, but Opendoor and most other iBuying competitors are seeing no such problems. To me, it seems pretty clear that we're not getting the whole truth here. The only problem is working out what the missing link really is. But as I mentioned earlier, this news is a couple of weeks old now, and more recently, there has been some more news to suggest that maybe Zillow weren't being as truthful as we'd like them to be. Just a few days ago, this news piece started circulating revealing that Zillow has listed 93% of the homes that it owns in Phoenix, Arizona at a loss. Now, just looking at that title, that should be a little bit shocking to you. This company that supposedly uses the best technology in the world, the most advanced algorithms in the world to determine what a property is worth, what it will cost to renovate and how much it will sell for, is getting it all wrong. Maybe the idea that Zillow doesn't actually want to be buying up these homes because maybe they're not selling for what they thought they would, maybe that's why they're halting this program, and the supply and labor shortages aren't actually a major factor. The article goes on to give more data that really doesn't put Zillow in the best of light. Zillow is listing more than half of the homes it owns in its key cities for less than it originally paid for them. Insider reviewed all the homes for sale by Zillow in the Phoenix metropolitan area as of October the 27th. Out of the 224 homes, 208 or 92.9% of them were priced below what Zillow paid. 36.5% were listed for less than the company first paid for them from the outset. The rest received price cuts in the days and weeks after initially listing for above purchase price. Only 16 homes were listed above Zillow's purchase price, and all of them were listed in the last 2 weeks, suggesting that those units too could fall into the red in coming weeks if Zillow is not able to sell them quickly. Now, I don't know about you, but that doesn't scream to me that the housing market in Phoenix is healthy. The way iBuyers and Zillow in general work is that they always buy homes at a discount to the market rate. They operate just like those We Buy Any Car companies. They find out what the asset is actually worth, then they take 10% or 20% off the real price to ensure that they make a profit no matter what. Zillow would have been buying those homes at a discount from the market prices in the first place, so the fact that they are now selling for even less should be worrying to us. Almost all of the homes they have bought recently are now worth less than what they used to be in Phoenix, and while it's not quite as bad in other cities, the trend is the same across the entire US. If you want to read that entire article, then I'll post a link in the description for it down below, but it is stuck behind a paywall. If you're a patron of the channel, then I'll post the entire article for you on my Patreon so you don't have to pay for it at all. Now, call me skeptical, but after reading this, after hearing about the trouble Zillow is having with selling homes, I just don't believe that they actually want to be buying these homes anymore. They claim that they do want to keep buying these homes and they'd love to keep doing this, but that they just can't get the homes renovated because of the supply and labour shortages. When in reality, they are unable to sell these homes for more than they paid for them, and that's after they spent money improving them. That just screams to me that the market isn't as strong as they'd like you to believe it is, and they're taking their money out of the markets because they're not seeing prices go up anymore. Now, Phoenix was one of the best performing markets over the last year. Prices went up 33% year over year from August, so it's not too surprising that it's one of the areas that is seeing its market soften first. They've already had huge price appreciation at a completely unsustainable rate, and so maybe we're now seeing a reversal of that trend. Now, luckily for us, Zillow being the huge company that it is, there always seems to be someone with a bit of inside knowledge willing to give us all an insight into what's really going on. And this time we have Zillow's ex-CEO who recently went on CNBC to tell us what he thinks is going on.
Great to have you back, Spencer. Good to see you again.
Thanks, Carl. Thanks for having me.
So can you clarify the issue here? Is this really about a backlog?
Yeah, so what's impacting Zillow today is that it's pausing home buying, not because there's too little supply of homes to buy, but because there's been too much demand for iBuying. So it reinforces two things I've been saying for years now, dating back to when I pivoted Zillow into the iBuying space and then when my SPAC took OfferPad public. Number one, there's enormous consumer demand to sell your home to an iBuyer because it's such a better consumer experience than selling your home the old way. But number two, to be a successful and profitable iBuyer, you need extraordinary local market expertise and operational execution. So, I haven't been inside of Zillow for a couple of years. My SPAC took OfferPad public. I can say that I know OfferPad is very focused on its real estate ground game. I happen to think that this current pause at Zillow, where I'm still a large shareholder, is company specific. In the meantime, it's good news for OfferPad, good news for Opendoor. In fact, OfferPad just expanded into California today. It launched 4 new markets the last 2 months. So Opendoor and OfferPad are growing really quickly. I think it's temporary. It doesn't change my investment thesis on the overall space because this method of selling your home will continue to gobble up market share versus the legacy method. And over time, Zillow, OfferPad, Opendoor, and probably others will continue to benefit from this consumer trend of selling your home in this way.
What about those who want to say it's an argument, some sort of macro indicator about where housing is going in general?
Yeah, well, housing is slowing. I mean, we've been on this tear, I think 10, 20% year over year rates of appreciation, and it is starting to slow. Absolutely. I don't think you're going to see home price declines, but you're definitely seeing a lower rate of appreciation. And there's more inventory coming on the market. There are about 1.5 million homes that were in mortgage forbearance, which can now actually go through a foreclosure process. So you'll start to see more inventory coming. That is starting to slow the rate of appreciation. But iBuyers that are doing a great job on the ground, buying homes quickly, renovating them and reselling them, whether it's OfferPad, Zillow, or Opendoor, I think they'll be able to do very well even in a slowing housing market. Because in a slow market, the value of an offer from an institutional buyer is actually more attractive to a seller. Right now, in a very hot market, a seller can just list their home and get a high price without having to sell it to an iBuyer. So it's a little bit countercyclical. I think iBuying will do well through downturn. Of course, we haven't seen it through that cycle yet, but I think, and I've done a lot of work on this category and I'm very invested in it, I think it'll do well through a downturn.
So Spencer, though, give us the worst case scenarios here, because, as a long-time business reporter, when I see inventory stack up for reasons that are external to maybe the market forces that the business had in mind when they constructed their model, it raises an eyebrow. Even if this is about being able to get houses ready and the availability of the workforce to prep them, to renovate them, what's the worst case scenario if any of these companies ends up holding inventory and economic conditions change?
Yeah, so they have to work through their long tail of inventory. I mean, there are homes where if you pay too much, then when you resell it, you're going to lose money. And so I think the Zillow pause is all about trying to work through their existing inventory. Again, I'm not on the inside of Zillow at OfferPad where I do have better insight, making sure that OfferPad buys homes, renovates them, and resells them quickly and doesn't have a long tail of problematic inventory. That's something I know OfferPad is very focused on. I think this pause is temporary at Zillow, and you'll see them work through this long tail of inventory and probably restart iBuying probably late this year or early next would be my guess, but I'm not on the inside there. I used to hate coming on your show when our stock was down 10% when I was the CEO. Now, of course, I'm not the CEO anymore, and so I can come on and prognosticate I'm not on the inside, obviously, so you'd have to ask Zillow.
So Spencer obviously doesn't work with Zillow anymore, so you'd hope that he'd be a little bit more honest when it came to the company. That being said, he is still a co-founder of Zillow, he is still on good terms with the company and those who still run and work in it, and he's still a major shareholder. So it really isn't outside the realm of possibility that he might not be telling us everything he thinks in order to not damage the company. The company that he is now running, OfferPad, also works in the same iBuyer space. So if he did think the market was going to take a turn for the worse and it might damage that industry, he probably wouldn't tell us anyway. He did also mention that he doesn't work for them anymore, so he doesn't have that inside knowledge that he used to have. So this is all just his opinion. He doesn't really know for sure what's going on, just like we don't either. But what about what he actually said? Well, he said that the housing market is slowing down for sure. There are far more homes being listed, but he still doesn't think the market is going to actually go down at all. He just thinks that it's not going to be rising by as much as it has been. Those homes that the banks have been waiting for months now to take control of and sell them because people haven't been paying their mortgages, well, they're on their way into the market as well, which will flood supply and will help soften the market as well. My only real problem with what he said there is that the problems that iBuyers are seeing right now is that there's too much demand for their services and they can't keep up. Now, this really doesn't make much sense to me at all. If demand for selling to iBuyers is up and the iBuyers can't keep up with that demand, then the prices at which they would be able to buy these homes would be going down and they would be able to make more money on each house bought. If that were the case, then I don't think Zillow would be making huge losses on every house that they're buying in Phoenix, and I don't think that they would outright stop buying homes either. They might slow down if they really were constrained by supply, but they wouldn't just outright stop their largest revenue source unless they foresaw problems with the market as a whole. So what does this really mean for the market in the long term? Well, here's where we are probably going to disagree. I don't believe Zillow are telling the truth here. I think they're worried about the markets as a whole and especially their ability to stay solvent in the market if it takes a turn for the worse. I just can't see why else they would slam on the brakes, destroy their growth prospects and put the entire company's future in jeopardy if that wasn't the case. If nothing else, then Zillow is clearly a poorly run company and I certainly wouldn't want to have any of my cash invested in their shares. I also think that this is a sign that Phoenix in particular is seeing its market soften and there's a strong chance it's only going to get worse. We know that a similar thing is happening in a bunch of other cities as well, most notably in Boise. In order to be sure that the market as a whole is going to start suffering, however, I would like to see some other iBuyers come to the same conclusion as Zillow. Right now, Zillow is alone in going in this direction, but that doesn't mean others aren't going to follow. If the likes of Opendoor, Redfin and OfferPad also start to wind down these operations, then the chances are that the data they have shows a market downturn is coming, and that would be a real reason to get worrying. But we shouldn't expect companies who are exclusively iBuyers to wind down these operations. They don't have other parts of the business like Zillow do to fall back on if iBuying stops looking so profitable, so they would have to continue doing it altogether. If you're new here, then consider checking out our Patreon. We're building a community of investors where we can talk and discuss all kinds of ideas just like we do on this channel. You also get access to loads of exclusive content that isn't available anywhere else, early access to all videos, private live streams and buy and sell alerts from my personal portfolio. And you can help support the channel for as little as $1 a month. If you want to read those Business Insider and Bloomberg articles but you can't because you're stuck behind a paywall, well, I've posted those full unedited articles onto my Patreon as well, and that's something I do all the time. On top of all that, once we reach 100 patrons, I'm going to hire a full-time video editor to help me put out even more content just like this. If you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. There's also a link to my other channel down below in the description that you can check out as well. In the description, there's a link to my favorite brokerage called eToro, where you can trade stocks and shares, crypto, commodities, foreign currencies, and more, all for 0% commission. And there's also a link down below in the description to BlockFi, where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold. Whether it's Bitcoin, Ether, or even stable coins, you can earn as much as 9% interest a year. Thanks for all the support. Thanks for watching. Stay stoic. Until next time.